Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, is a share trading business good or bad? Answer by Santoshi Chawla. There is no doubt about the fact that stock market trading can be a career. Though it is often said that stock market investment is risky, with little effort you can earn regularly from the stock market. All you need is the right strategy and skills to choose the right stocks. Besides, you should have ability to take risks and stay positive even at the bad times. For that, you should have a clear understanding of how the stock market operates. You need to follow the regular movement of the stock market very closely and analyze every effect on the price of the stock with a reason. You have to spend a great deal of time not only in investing in the stocks but also in analysis of the companies and stocks that are on your priority list. These are the basic things that you need to build a career out of stock market trading. The first thing that you need to have is a strategy for investing in the stock market. You cannot afford to make some arbitrary investments here and there to make a career out of stock trading. You have to carefully draw a plan and most importantly stick to that plan all along. When you are opting for a career out of stock trading, you should ideally diversify with your portfolio. You should keep some investment for the long-term investment at the blue chip company that will give you good return in future. You should use some portion of the portfolio for day trading that will add up to your monthly income. If you want to earn income from a dividend, you can also investment some portion of your fund to the dividend stocks. These strategic investments should be made depending on your target from stock market investment and your fund. Apart from making strategic investment, you have to make sure that you invest at the right stocks that are most likely to appreciate in the future. To identify the stocks that have really good potential, you have to do fundamental research to see how strong the company is. Remember that your profit and loss largely depends on the stocks you select. You can use the online stock tips and other tools to determine the potential of the stocks and the price level at which you should invest at the stock. But it is always wise to bank on the results of your own analysis of the stocks. Before investing in a certain company, you need to evaluate how fundamentally strong is the company. What are the future potential of the company? Only if you are satisfied with the prospects, then only you should invest in that company. So the bottom line is, follow your own instincts and do not depend on others for taking your investment decisions. All said and done, you should always keep in mind that stocks market trading does have its risk, as so many factors determine the position of the stock exchange. So you cannot rule out the possibility of making loss at some of the deals. But you have to make sure that your profit is more than the loss. The key for success at stock market is to make more profitable trades than trades that have incurred you loss. Hence you should carry out thorough research of the stocks and carefully weigh all the pros and cons of a stock before investing in it. You can also take help from the stock market experts and analysts, but make sure you take the decision yourself, as it is after all your money that you are investing in the market. For further strategies or investment related queries, try Swastika InvestSmart Limited to manage your wealth profile. Click here to open an account or feel free to contact us. Answer by Akanksha Sharma. 5 things you must know before buying shares or share trading. How to invest in an IPO. 1. You own a part of the business. When you invest in stocks, you do not invest in the market, despite what you think. You invest in the equity shares of a company. That makes you a shareholder. You now own a small part of that business without having to go to work there. The good news is, since you own part of the company, you are entitled to a share in its profits. The bad news is that you are also expected to bear the losses, if any. That is why investing in shares is risky. If the company does well, you benefit. If it does not, you lose. There are no guarantees whatsoever. 2. In the short run, the price of the share can wildly fluctuate. Let's say the company fixes the price of each share at 10 rupees. This is called the face value of the share. When the share is traded in the stock market, this value may go up or down depending on supply and demand for the stock. If everyone wants to buy the shares, the price will go up. If nobody wants to buy the shares, and many want to sell them, the price will fall. The value of a share in the market at any point of time is called the price of the share or the market value of a stock. A share with a face value of Rs 10th may be quoted at 55 rupees, higher than the face value, or even 9 rupees, lower than the face value. So you might have paid 15 rupees for a share which is now quoting at 12 rupees. Don't panic and sell. If it is a good company, the share price will eventually rise. The prices will get influenced by the market sentiment and the general direction of the market. As a result, you may see short-term slumps. 3. Always invest for the long term. The best way to make money is to buy low and sell high. This means you should buy the share when the price is low and sell it when it is high. That is why you must buy in a bear market. This is a term used to describe the sentiment of the stock market when it is low and the prices of shares have generally fallen. The best time to sell is in a bull market, when the sentiment is high and the prices of shares are rising, but it is very difficult to time the market. In fact, no one can do it. If we could, we would all be millionaires, wouldn't we? That is why, when you invest in the market, it is best to invest for the long term. Hold onto your shares for a few years before you think of selling them. The companies increase their sales and book higher profits over the years. This will eventually reflect in the share price, so ignore the short-term slumps. Once you decide that you are in for the long haul, you can ride over the bear and bull runs with no stress at all. Over time, the price of your shares will appreciate. If you are getting a good price for your stock, keep selling small amounts at regular intervals. Keep booking profits. 4. Decide how much you want to invest. Always remember one basic rule in finance: if something gives you higher returns, that's usually because it carries a greater risk. That's the reason why not so good companies will pay you a higher rate of interest for your deposits. The same reasoning goes for stocks too. They give higher returns than, say, bank fixed deposits because they are more risky. So the amount of money you invest in the market depends on your capacity to bear the risk. If you are young with a steady job, you can invest a larger proportion of your income in the stock market than, say, your parents who are close to retirement. If you have a lot of debt to repay, avoid putting too much of your money in stocks. It's best to decide how much of your savings you will allocate to stocks, and stick to that plan. Don't get swayed by how much your friend is investing. 5. Don't rely solely on good advice. A smart investor should never buy shares of companies he doesn't know much about. Relying on advice from friends is not always a great idea. Do some groundwork yourself. It doesn't matter who is buying the stock or who is recommending it. Steer clear of such ways of making a fast buck. These tips will land you in a soup. When you hear of a hot tip, dig further. Take a look at the company's profit and loss statement, which would have been audited by chartered accountants. These tips should get you started. Tread cautiously though. If stocks intimidate you, consider a diversified equity fund. A mutual fund manager will research many companies before investing in their shares. This way, you can participate in the stock market even as you leave the research to professionals. Footnotes. 1. https://www. Money Classic Research. Answer by Vimal Kumar. Why people trade in shares. They wanted to generate income/profit. If generating income/profit is bad, then don't do it. It is another way to create wealth, like investing in gold, real estate, bank deposit, etc. All investment carries certain amount of risk involved in it. The amount of risk varies with the type of investment. Bank FD carries less risk and less income, whereas share trading has more risk and more income if done properly. Some of the basic rule for share trading that I follow is: never trade in shares with borrowed money or money kept for some other purpose. Before investing, study the script properly. Know the fundamentals of the company in which you are investing. You must have patience. Review your investment periodically. Do not follow others' advice, be your own judge. Best of luck.